Some time ago, I was talking to a trader, someone I know. This is a person who in the past had also worked for investment funds. Not the typical trader who shows off trading on Instagram, but rather someone truly knowledgeable in the field. At a certain point, he says to me, "In my opinion, there's no point in using percentage-based risk. When you do backtesting, it's much better to use a fixed lot size because that way you can really understand the quality of a strategy." At that point, I didn't respond because I didn't know what to say, since I usually always use percentage-based risk. So I went back home, opened my MetaTrader, and started running some tests to try to figure out if what he told me was true. Or maybe it just didn't fit with what I do. I wanted to dig deeper into the topic because I was curious to understand the truth behind it. In short, I wanted to understand what was really going on. So after all these tests, what did I find out? That even when you're experienced, it's easy to make a mistake and get something wrong. In this video, I'll show you with real data what changes between using a fixed lot and percentage risk. Because using a fixed lot can completely distort reality when it actually makes sense to use it, and most importantly, what the correct method is if you want to do real trading. Welcome everyone, I'm Andrea, your automated trader, and if you like what I do, leave a nice like. Subscribe to the channel and turn on the notification bell so you don't miss the next videos I'll be posting. When I got home that evening, I started to seriously think about what he had told me. This person, because as I told you, I always work with a percentage of the balance I have in my account. For me, this way of managing risk comes naturally. So after I tested and tried various things, I understood where this confusion comes from. The key point is this: using a fixed lot size does not guarantee risk control. It only limits the maximum position size. But the actual risk keeps changing all the time, and this becomes very risky and dangerous if you have a strategy or an expert advisor that works adaptively with the market. So it changes its trades based on market conditions. It doesn't always do the same thing. Now I'll show you one of my expert advisors so you can better understand what I'm talking about. Here we are on MetaTrader. Let's open our strategy tester and take a look. I'll take this strategy that I use on Bitcoin as an example. This is a fairly simple strategy, let's say, and it works like this. I identify a range during the day between two specific times. And if my price, after a certain time, breaks out upwards or downwards from these two levels, I go long or I go short. So the concept is very simple. Basically a breakout at a defined time. Of course, the strategy is a bit more complex. I have a whole series of filters, but the basic idea is this. So this is the kind of trading we do, based on specific times, right? What happens then? We try both using a percentage of the balance as a stop loss and using a fixed lot size. So first of all, we run it with our chosen risk percentage. How do I do it? Always just as I created the strategy, and let's see what happens. Let's run a test in OHLC mode, since here we just need to do it quickly, even if it's a bit less precise. But you know that the experts I create aren't really affected by whether the model is reality or OHLC. The results are more or less the same. Here, the important thing is to understand what changes between using a fixed lot size and a percentage risk. So let's run the test over 6 years. So we have a long enough period to see the differences. Are we taking risks here? 1% per trade? Let's see what our equity looks like. So the equity is this. It's an equity that rises fairly regularly. Here it had a moment of drawdown. However, it's generally a good equity. Here it rises, which is rising quite steadily without any major drawdowns, except for this point here. Now let's go and make a change. And let's set a fixed lot size. Here I'm using 10,000 euros. So for Bitcoin, let's maybe set 0.15 per trade. So from the beginning to the end of our test, we use a lot size of 0.15 and see what changes. Let's run the test and see if the equity changes, stays the same, or is similar. The test is finished. As you can see, the equity is completely different. And why is that? This happens because the range we trade every day is not always the same. One day it might be large because there was a lot of movement during the hours we consider. Another day it might be very small. So by using a fixed lot size, if the range is small, our risk is small. If we have a large range, our risk skyrockets. So maybe one time we're risking 1% and another time we're risking 5% because the range is 5 times bigger and we're always using the same lot size. So this impacts the strategy. And you see that yes, it does make a profit, but it completely changes the entire equity curve. There are even parts that are practically flat because there the ranges were probably large or small and we risk too little. So we're no longer managing risk. We make one trade with a lot of risk, another with little, and the whole system gets a bit distorted because it becomes based on luck. Maybe that day I was lucky that with that lot size, I had the right range, I risked a lot, and the trade went well, or the next day I risked too little and the trade went well, but it didn't make up for it anymore. In short, you've kind of distorted the whole system. Now, however, here comes the paradox. There are situations where using this fixed lot size makes sense. When does this happen? This happens when the strategy always stays the same over time. So, unlike the example I showed you where it's something adaptive that changes day by day, here it's something that always stays the same. For example, when does this happen? A simple example. I enter when I get my entry trigger and I have, let's say, a 100 pip stop and a 200 pip target. Those values are always fixed, so if I use a fixed lot size, the risk is always the same and everything is calibrated. So in this way, if I use a fixed lot size, however, I'm giving the same importance in my backtested trades that happened a long time ago as to the most recent ones. Then, of course, you also need to apply this strategy to a market where the price more or less stays within the same range, because if I have a 100 pip stop and a value of 1,000, then maybe the underlying asset I'm trading, it goes from being worth 1,000 to being worth 5,000. I still have a 100 pip stop, but again, the percentage changes a bit. Everything. No, because the price is much higher, and so it's no longer the same thing I was doing at the beginning. If, on the other hand, you trade euro dollar, it's more or less always worth between 1 and 1.50. Always in that range, you're basically always doing more or less the same thing. So, in real trading, this situation is very rare. You actually have to kind of create this situation yourself if you want to use fixed lot sizes. Then there's a concept that almost no one explains. If I'm using 10 years of data in my test to do an optimization, I don't want the data from 10 years ago to have the same weight as the data from recent years. Why? Because my strategy needs to work well, maybe in the last 2 or 3 years, and just survive with the market from 10 years ago. Because that market no longer exists today. Today we have the current market. How can I do this? I use compounding, so I use percentage risk. Because in my test, I start from the beginning when the account is small, I move forward and my account keeps growing. So unconsciously, I'm giving more weight to the final trades because the account is larger. The profits are bigger, and so in my optimization, I'm doing something that fits well with the most recent periods. And it's not that it performs badly, but it fits less well with the initial period, which is exactly what I want, right? So using a fixed lot size is useful for analysis in certain cases, while percentage risk is useful for surviving in the market. I don't trade to have nice looking equity curves. I trade to put money into a real account. And in the real world, risk is always managed as a percentage. If you found this video useful and enjoyable, send it to a friend on WhatsApp, because that's how important information gets around. See you in the next video.